Should you buy local, buy in the south, or buy cheap property up north? For property investors, getting this decision wrong can cost you thousands of pounds and potentially put you back years in terms of wasted time. Most property investors I talk to are looking to generate another income stream. Buying property in the south is harder to make cash flow with rising interest rates, unless you manufacture some profits through a refurbishment or an extension. Plus, you're going to need a lot more money to buy in the south, as house prices are at least double those of those in the north for a similar type of property. I'm going to cover 5 critical factors you need to be aware of before you buy a property in the north or in any particular region that you're not familiar with. These 5 factors are the property formula, crime, growth, distance, and the profits. Getting crystal clear on each of these factors is going to enable you to buy the right property in the right location that will then also meet your financial goals. If you've got any questions as we go through this video, please leave a comment below and I'll do my best to answer it. So the property formula works by looking at 2 particular attributes of an investment, and that will then give us the type of property that we should be going for. So the type of property you purchase is one of the most important considerations you're going to make, because it's going to be dependent on the type of tenant that you want to attract. So for example, houses that have, say, 3 beds and that have good sized garden, these are naturally going to attract families. And families are also going to be looking for good schools. So properties that are near good schools, has got good amenities, close to shops, has got good transport links. Those types of properties are going to be well in demand compared to properties that might be 3 beds with large gardens but not have access to all of those types of things. Flats will attract singles, students, young professionals, and even seniors, because they're looking for low maintenance properties that they don't have to look after too much. Flats with a large garden, they'd get put off and they'd see that as a negative. They don't want to have to get the lawnmower out and start mowing the lawn. As an example, we could quickly draw up a matrix and understand what type of tenant would be most suitable for what type of property. And that would look something like this, where we've just got like a family, they're looking for a house and they want at least 2 beds, or we've got a young couple, they want a flat and they want at least 2 beds. Or we've got a senior person and they want a flat and they want just 1 bed. Demand is critical if you want to avoid the silent killer of property investments, which is vacancy rates. So to assess demand, one of the best ways is to go and check with the local estate agents. Go and ask them what type of properties are hot at the moment, which ones are the tenants phoning up the most about in that particular area. It could be a mix, it might just be one property type, but then your budget and things like that will come into play as to what type of property you want to go for. Another way to assess it, if you just want to do stuff remotely, is to look on Rightmove and click on the box that says that properties are already let, and see how many properties have been let based on certain property types. So are they mainly flats? Are they mainly houses with 3 beds? Are they houses with 2 beds? You know, what's the majority of the property that's getting rented in that particular area? So the formula here for determining the right type of property to buy is the tenant profile plus the demand will equal the property type that you should go for. And we can then add another column to our matrix and put in the demand here. And this demand comes from the extra research that we're doing when we're talking to agents, or we're looking on Rightmove or Zoopla and looking what properties have actually been let in that particular area. And we can simply put high, medium and low demand to help us understand a bit better where the demand is likely to be. So the second factor is the crime rates. Now, crime in any area is an important consideration, because at the end of the day, you want to buy a property that your tenant's going to want to live in, and a house that's going to go up in value over time, hopefully. And if it's a crime-ridden area, property values tend to stagnate or even drop. So it's your job as a property investor to understand where crime is rife and understand which areas are good, where there's lower crime, and areas where there's higher crime, and then narrow it down even to the streets that are safe streets or not so good streets, and kind of then this will help you target specifically where you want to be looking, because in an area there's also good and bad areas, or higher and lower rate crime rates. It could be that the whole area is still acceptable for you. So you kind of need to understand what level of crime is too much. You know, there might be massive rife with drugs in this particular area, or this area is just based because it's near a high street, there's lots of shoplifting and stuff like that, which isn't really relevant to you owning a house within half a mile from that, because your street, for example, is pretty safe. There's been one burglary in the last 10 years or something like that. A website that I use to do this type of research is a website called crimerate.co.uk, and it's quite good because there's lots of graphs on there, graphical displays, and it's all based on police data, which is openly available. They just collate it and put it into a graph. And it goes back to 2010, so it's got a bit of history there, so you can see how crime has progressed over that time. Has it got worse in that area? Has it got better? I recommend going and checking this website out if you haven't done already, and it's really going to help you understand what types of crimes are going on in the area that you're looking to buy, and it might mean that you look into a different area where those types of crimes that you're not happy with aren't occurring. And you've got to think about your tenant again when you're looking at crime, because if you're buying in a certain type of crime area, what's the type of tenant that's gonna be frequenting that area? You could buy an A-class home in a G-class area and you get a G-class tenant. Ultimately, your A-class home will turn into a G-class home. So you're really gonna be regretting buying that A-class home if you're going to be attracting a G-class tenant. So the third factor is capital growth. Now, historically, capital growth has been more so in the south than it has been in the north. But in the last 2 years, the north has surpassed the south in a couple of areas. And growth, again, is driven by tenant and buyer demand. So if there's a lot of buyer activity, prices are going to rise. If there's a lot of tenant activity, rents are going to rise, which also makes it more attractive to investors and buyers, and therefore property prices increase. And that's exactly what we've seen in some parts of the north. On top of this buyer and tenant demand, growth is also driven by the opportunity for jobs and good transport links, amenities. Is the area up for regeneration? Is the local council investing a lot of money gentrifying the area, improving the facilities for the local residents? Is there new transport links getting put into that area that's going to also improve the connections to other areas so people can reside there while they travel by train maybe to their job that's further away, but they can come back to it? So the better the transport links are, the more that people can stay in the areas that aren't necessarily close to a city because there's good transport links to get them into the cities. What I used to see historical averages on house prices is I go to the land registry website. It's a total free site to use, and you can search stuff just by the location and then property types, and it gives you an average over time, and you can see the trend of how average house prices have changed over time in that particular area. And I also use property data, which is a low-cost paid tool that allows you to see projections of capital growth for particular areas down to that particular postcode even. And there's lots of other details that property data has that helps you analyse properties and areas and things like that, which I'll probably go into in another video, but I'll put a link below to property data below if you're interested in that as well. So the fourth point is distance to your home. Now, distance is an important consideration, especially if you're looking at getting more involved with your property as an investment itself. So if you want to fully manage them or something like that. For me, distance from my home is kind of irrelevant. I'm happy to buy properties sight unseen, remotely, even in different countries. Doesn't worry me, as long as I've actually gone to the area, walked the street, spent time there, understand the area from a perspective of which locations would I buy in that area, which are the areas to avoid, what's it like at different times of the day, what type of tenants are buying for these types of property that I might be interested in based on my budget. So if I know those things, I'm happy to buy sight unseen and remote. It doesn't worry me. But for you, if you're just starting out and it's a whole new area, you need to spend some time in that area before you decide to make any offers on any properties, because that's just good due diligence. So you may decide that an hour from home is a good distance you're happy to travel. So good things about Rightmove and Zoopla is that you can put a distance in there and use your home address or your home location as your starting point, and you can just say, well, I'm happy to go 40 miles around from wherever I live. And then so you could start your search based on that criteria initially, because within 40 miles, that's a happy distance you can kind of do maybe within an hour. And then once you've worked that out and you've started looking in that circumference of your house, then you probably want to narrow that down, because otherwise you'll be totally overwhelmed with the number of properties that are going to be coming in if you're doing something like 40 miles radius of where you live. I know for me that is overwhelming amount of number of properties that will come back on, say, Rightmove. So based on these other factors, you want to start narrowing it down. What's the crime rate like? What's the growth rate in this area? Where's the tenant demand? So you can see how these pieces of the jigsaw start fitting together for you to actually narrow down specifically where's your target area that you want to be investing in. And once you identify that target area, that's the area you should narrow your focus to. You don't need to keep that circumference 40 miles from your home. You go, oh, it's this postcode or it's this specific town that I want to focus on, and say an hour and say a 1 mile radius around that. That way you can get really laser focused on the types of properties you want to meet your target tenant based on your budget that you've got available. So the last factor is not last because it's the least important. It's just also as equally important as any of the others. Some people might go to this one as their most important one, but for me, it's more of an equilibrium with the others. Get the others right, you can then get this right. So this one's called the net cash flow, which ultimately is your cash on cash return that you'll be making based on your cash down and how much cash back are you going to get from your investment. And I've noticed that a lot of people will look at numbers, as in, I want to be making £500 per month return, rather than looking at an investment as a percentage return. For me, I'm always looking at stuff as a percentage return, because if I just say I want £500 a month from this property, that property may cost me 500 grand to buy, it's generating me 2 grand a month in rent, and it's generating me 500 grand a month as a cash flow. So yeah, tick box, but it's not really a good return on your money that you've put down to generate that £500 per month. So that's why we always need to do our numbers and understand our cash on cash return as a percentage to understand, are we getting a good return on our money down? To work out your cash on cash return, you need to add up all the costs that you've spent to purchase your property and identify how much cash out of your own pocket has gone into that amount of costs. So as an example, you've got this property that's 170 grand and you may have put down £50,000 out of your own money. Then you want to add up all the expenses that's cost you over the year to own and operate that property. You've got your total rental income and you've got your expense figure. So you take your expenses from your rental income and it should be a positive number. And then you take that positive number and you divide that by your cash down, and that gives you your cash on cash return. Here's an example of a property up north. It's in Nottingham, it's in NG7, and it's a property that was sold for £170,000. So I'm saying that we've got legal fees £650, stamp duty costs of £5,100, home buyers report £450, bank fees £995. So total cost is £177,195. We can get a buy-to-let mortgage, 75% at 127.5 grand. We're also going to turn this into a HMO, so we're going to have an HMO licence cost to the local council of £1,400. So cash required is just over £51,000. We can generate from this, if it's a HMO, a rental income of £1,900 per calendar month. We're going to have some expenses with this property each year. I've not gone into the warts and all stuff of making it HMO compliant, like fireproofing doors, different things like that, because I'll be here all day going to the nuts and bolts. I could say, well, that's another 5 grand or what have you. So it's up to you if you want to put that in there and deduct it, but it's a one-off cost. Once it's done, it's done. I'm kind of more talking about ongoing costs here, so ongoing cash flow each year. So we've got the mortgage, which is a 4.69% mortgage that we can fix for 10 years at the current rate. That would be £498.31, which equals just under 6 grand a year. We're going to have a property manager in place at 15%, which is 3,420. Maintenance and repairs have allowed 10%, 2,280. Vacancy rate 5%, 1,140. Buildings insurance, landlords insurance, certifications, and then utilities bill of 4 grand I've added in there, because with HMO you've got to pay for the electric, the gas, internet. 4 grand, may even be on the light side. Who knows in the current climate with the energy costs are rising. So this is kind of like the silent killer for HMOs at the moment. So that's why you might see a lot of HMOs on the market. The risks reward versus the high rent versus the expenses that are a bit liquid. This would work out at 17,769 total expenses. Deduct that from our rental income of 22,800, gives us 5.5 grand net cash flow, which gives us a cash on cash return by dividing that net cash flow divided into our 51 grand cash down out of our pocket, gives us a 10.83% return just on that one particular property as an example. So before you buy a cheap property up north or in any region, it's worth considering these 5 key factors before you spend hours and hours scrolling through Rightmove and getting overwhelmed by the number of properties that you're looking at because you're just trying to look at everything at once. Getting clarity on these 5 factors will help you get laser focused on your target investment area and also get really focused on the type of tenant that you want to attract. And this then will allow you to identify the type of property that you want to be going for, also based on the return that you want to be making and the budget that you've got available to spend. Before you go, YouTube recommends that you watch this video next, so please go and check it out. Thanks very much for watching. I really do appreciate it, and I'll see you next time.